Well, good morning, everybody. Welcome to the June 2021 webcast version of Expected Returns. My name is Mark Robertson. I'm joined here by Kim Butcher. Good morning, Kim. I trust that the weather is treating you well down in Florida.
Yes, I believe the high should be about 88 today.
Cool. Well, what we want to do here today, and we'll kind of roll through this quickly, but basically the message here is this is something of an experiment. As many of you know, there are so many familiar faces and names in the room. Much of this won't be a surprise to any of you, but a while back we did kind of de-emphasize, when we say we, that would be the royal we, as in me, de-emphasized the monthly newsletter, and we have continued to publish aspects of it, sometimes later than it should have been or whatever. I'd kind of like to put an end to that and go back to re-emphasizing it. The reason I want to do that is because it does push me into some interesting areas, and that's generally good for all of us. At Manifest Investing, those of you that have been around for a while, you know that we focus in on sharing ideas and focusing on opportunities and focusing on the important characteristics of investments, specifically the quality and the return forecast with a slew of investments. And we generally like to do it together and sharing ideas, that sort of thing. And what I would like to do on these Saturday morning sessions, on the first Saturday of every month, come together and just kind of go over what's in this monthly newsletter. For example, we're going to talk here this morning about the recent COVID cancellation conference. It's actually our Successful Investing Conference number 3. And we'll just kind of share some of the highlights from that and show you where you can get more if you want to know more about that. The stock that I chose to take a little bit of a deeper dive in this month was Regeneron. And we'll talk about that. Also want to talk about Kathy Wood, ARK Investing, and her big ideas and how we presented that during the Successful Investing 3 conference. And then get back to some screening stuff with triple plays and zoning. We had some interesting moments during that conference and since then that we do want to share. But the message is, this is basically an experiment. We want to try to do and build things which are meaningful to all of you, while continuing to nurture a continuous stream of actionable ideas. The thing about the newsletter is, you're constrained to paper, and not everything fits on the paper. So what I find is there's often some fairly interesting and good stuff that ends up on the cutting room floor, and this venue gives us an opportunity to show some of that also. So that's basically the story. It's an experiment. It's a bit of a homecoming, as I've featured on the Manifest Investing website. We are working on some interesting new features at the website as soon as we can get the software upgraded in place. And I see some interesting days ahead in terms of discovering some of this kind of stuff. So let's go ahead and get underway. You good to go, Kim?
Absolutely.
All right. Standard disclaimer. No investment recommendation is intended. You guys all know this. It's about sharing the lessons learned over 8 decades with the Modern Investment Club movement. Everything we do here is about education and demonstration and illustration. We will be sharing opinions. We do try to share whenever we own a company that we are talking about. And just keep all that in mind, but always do your own homework. In addition to this monthly webcast, we have a second monthly webcast known as the Roundtable, which is always on the last Thursday of every month. We'll be more about that as we go through the session. If you have any suggestions for future bull sessions or expected returns topics, or just simply would like copies of slides or have a follow-up question, send an email to markr@manifestinvesting.com, and we'll do our best to see what we can do.
And Mark, for a minute there, I think you mean that our roundtable is the last Tuesday of every month, not Thursday.
Did I say the wrong day again?
You did.
For some reason, I want to move that to Thursday in my brain, and we need to fix that. All right. Well, here's a look at expected returns and what's in this edition this month. I will be finishing up the cover story here in a few minutes, and the entire issue will be available in PDF for those who like that. But just some highlights from the conference. We're going to cover that here. Regeneron, stock that is no stranger to most of us. It's been featured a number of times in discussions and at the round table. Going to take a look at the fund super investor leaderboard that is led currently by ARK Innovation, ticker ARKK. And let's talk a little bit about screening, Tin Cup, an update on Tin Cup, and just a reminder about bull sessions. Here's some of the feedback we got after the May session. Again, it was our third successful investing conference, nicknamed the COVID Cancellation Conference number 3. We were relieved that so many of you did not get worn out during our marathon session on stock picks. We did run a little bit long, but boy, did we ever get some nice feedback. And you can see that there in the second one. Elegant and wonderful. That's obviously a tribute to some of the stuff that Ken talks about all the time. That next one, I swear with my hand up, my right hand raised up in the air, that didn't come from a family member or my wife or anything like that. That's actually from a subscriber / attendee. And the feedback doesn't get much better than that. Obviously, I sent the slides immediately to that individual. And then I love the last quote that came up. Our next conference, Successful Investing 4, will hopefully be known as Canceled COVID Conference number 1. So
I really do like that title, Mark.
What, the Canceled COVID Conference?
Yeah, I really do.
I think it's time to cancel that, and not some of the other stuff that's been kicking around, but some good stuff there. All right, so let's go through some highlights from the 5 sessions that went on from May, I think it was May 12th to May 14th, just a couple of weeks ago. This is one of my favorites from our small company presentations. Just a quick reminder that small cap is not small company. And the rhino up at the top is just a tribute to the fact that Wall Street, this is one of the main things that Wall Street is probably never going to get right in our lifetime. There's only a few people who understand the difference, and we encourage everybody that hangs out around here to simply recognize that there is a difference. A small cap can be damaged goods. It can be a mega cap company that is suddenly a small cap because they are in disastrous peril. Whereas a small company, in the way that we think about small companies, we think about them in terms of being faster growing, promising companies. And that's what we try to collect. Now, there can be opportunities when some of those giants stumble and fall and go from a large cap to a small cap, but that is a special situation. That is not the type of thing that we typically try to do. All right. As an example of some of our best small companies for this year, this is just our quick update from top to bottom, some highlights. Notice the number of financial sector firms at the top of this chart performance-wise. These are the 20 companies we picked last Halloween as part of our best small companies for 2021. They're doing well, up nearly 50% versus 30% for the stock market. Some real nice ones on there. Kim, some of your favorites made the list. You were big on biotelemetry, I remember.
Yeah, and you know, I need to tell the audience that one of the ways I have found a stock is the most unusual of when you have to fly. I find out who's sitting around me, and it turns out I found this company because the guy sitting next to me was the regional manager. That's how I found the stock, and I must admit I found a few of these. So that's one new way to do your search methods to find a stock.
Absolutely. On the manifest forum, I actually detailed that we did finally decide, that royal we again. I got kind of tired of reading some of the confusing information coming out of China with respect to global cord blood. And I think we just call that a victory at the water cooler and walk away because it's just kind of a maddening situation. So we do not typically close positions unless we are forced to, but this is one where there's an offer to buy out the company at $5. It's currently at $6. I don't even know what to think about that. So some good stuff there. All right. In our portfolio design and management session that Ken and I presented, we actually went through and reinforced uh, some of the selling strategy stuff that we've been doing at Manifest Investing and with the Mid-Michigan chapter of Better Investing as we kind of explore just these fairly straightforward guidelines for when to sell. And the first one, which should be the vast majority of situations, is to make the portfolio better. Typically, you're going to be boosting the overall return forecast. And in some cases, if the portfolio is okay, but an individual component or holding, if it's a core holding and it's dropped down to less than money market rates, that can be time to sell. You can also sell a non-core holding if it's less than the market average return forecast. And also, we've been watching for companies that have significant deterioration of quality. So that, most of the time it's going to be just simply making the portfolio better, taking advantage of a selling opportunity, that sort of thing. The second one there, we had a lot of fun with this over the last couple of years. It's just a recognition that of the old rule of five, that for 5 stocks that you build expectations for, one of those will greatly surprise you to the upside, exceeding your wildest good expectations. 3 of them will pretty much behave in line with what you expect. And one of them, no matter how hard you study it, is going to misbehave. And basically around that concept, we looked at our portfolios and looked at situations where what if from the day you buy the company or add it to your tracking portfolio, it actually lags the market by 20%. So in other words, if the market went down 10% and your stock went down 30%, that sort of lagging involved. And that has actually turned out to be a lifesaver in a couple of instances, because I have one stock that I have followed for years. I don't know how many times you can lose 80% in a single stock, but I've done it 3 or 4 times in that one, and the math is not good. Third, Roman candle, we will consider conducting a selling evaluation if the relative strength index, RSI, is greater than 80. And that's just simply an acknowledgement that every once in a while these things take off and shoot up and give you an opportunity to do either a partial sale or in some cases a complete sale, on the heels of incredible sentiment or momentum. So those 3 things are what we do. So we ask the question, what if we just simply held and didn't do this stuff? Buy and forget. And we did a quick assessment with the roundtable tracking portfolio. Keep in mind, you're talking about several hundred. I think it's up to about 600 purchase decisions and then a number of selling decisions. And what you see here on your screen is, what if we didn't worry about this selling stuff? We just simply held everything that we bring to the roundtable. And that return would be not bad, 16%. So some pretty good ideas being floated there. But in implementing those 3 principles on the preceding screen, as a protective measure in some cases or opportunity in others, we see that we actually experienced about a 3.5% advantage to the buy and forget approach. 3.5% over a long period of time is massive. So we think that those rules, at least for this part of the demonstration, we actually run this in a couple other portfolios, and we will be updating that stuff. But that's reason enough for us to continue to deploy these 3 selling regimens at the monthly roundtables. Any comments or questions?
Well, I just want to say that it's never wrong to sell to capture a profit. Some people have a tendency to think that, oh no, it's going to go more, it's going to go more. Well, it's, as I say, if you're pulling off a few layers of the onion, every stock goes up, every stock goes down. You have a 52-week high, a 52-week low. There's nothing wrong with peeling off a few layers at the top and then reinvesting it when it goes back down.
Yeah, that's a great point, Kim. You just reminded me that we actually did look fairly carefully at, well, how many times have we sold a company only to watch it continue to skyrocket? And the answer to that is, after several hundred selling decisions, I can point to a handful of companies. I know Oracle was one of them, and there were a couple other companies, but I'm talking about a handful, probably less than 5, where that situation happened. So, something to think about. All right. During the Successful Investing 3 conference, we talked about this notion of theme-driven investing. And I spent a few moments with talking about the exploits of ARK investing, and that's Kathy Wood on your screen. And one of the things that I pointed the audience to during that session was her annual, comes out in January. You can see the January 26th here. You can retrieve this on the internet. If you need a copy of it and can't find it, send me an email. I'll be happy to send it to you. Her big ideas. And it really is a really cool collection of ideas that are steeped in innovation or disruption. Disruptive innovation, however you want to think of it. You can see the 15 different areas in there, from cryptocurrencies to one of Kim's favorite things, e-payment, digital wallets, and that kind of stuff, to some of the Tesla type stuff with electric vehicles. There's drones, there's 3D printing, a bunch of stuff with genomes.
One thing I don't see in there is gambling.
And we can actually talk about that, because I actually presented a few thoughts on gambling/gaming. This is just an overview of some of the stuff that, as they go through their process. But those 5 major theme areas down at the bottom actually have their own exchange-traded funds. And the innovation one is their flagship. But if you want to look for companies to study that are in the genome revolution right down the middle there, you can do that. One of the things we discovered, Kim, is that a lot of the stuff with respect to electronic gaming and gambling, etc., it crosses many of these. And they actually find, it's in fintech, it's in next generation internet, some of the stuff in the disruptive innovation. So the gaming stuff actually kind of crosses many different areas of the spectrum, to some extent, right, in the autonomous tech.
So, but I'm also thinking that in the media space of Spotify and Sirius Radio and Netflix and all that, those go across different areas, because it's the area of media, but it's also the next generation of the internet, and you got to have the right kind of tech to be able to do it. So yeah.
Yeah, so it did kind of cross those areas. So I actually did a bit of a case study on a number of slides. This is just one of the highlight slides, but a number of slides which showed the esports and e-gaming stuff that's going on. Just amazing when you dig into it and you see that they're beginning to draw crowds for some of these. I think of them almost as cage matches, with video games, and with crowds as big as the Super Bowl in the United States. It's just amazing. The companies on the left side of this chart are those that are affiliated with electronic gaming, and Kathy Wood has actually invested through ARK Investing in the ones that are highlighted, and these are sorted by their market cap. And a quick industry look at Y Charts, one of our data providers. But I do want the audience to notice, look at these profitability numbers. I mean, these are special. There's an awful lot of money to be made in gaming. And if you dig into some of these companies, sometimes you can find kind of an interesting opportunity. I happened to actually buy some skills, SKLZ, after doing this presentation. More on that in a minute. The companies on the right are actually from the gambling side of things. DraftKings is one of her holdings. Kim has talked about Golden Nugget Online Gaming. But again, taking a list like this and drilling into it, I spent some time with Aristocrat Leisure just yesterday. That's predominantly an Australian e-gaming firm. So it can be a wealth of ideas. Sometimes you can get in early on one of these. And I happened to buy skills fairly soon after Kathy Wood did for ARK Investing. And we're on a first name basis now, Kim. I don't know if you knew this or not, but Kathy,
I did share that.
Kathy sends me emails, and notice she sends it to me. So
It's addressed to you, yeah.
I might be the only one getting this email. And then this one happened to come last night, and it was up 27% on Wednesday. I gotta like that. I mean, this is one that I actually hold, and is in my special situations non-core part of the portfolio, and this is fun. But one of the
Mark, I guess I'm going to have to tell you, cha-ching.
Yeah, ka-ching. Well, one of the things that I find interesting about ARK investing in Kathy Wood is the transparency like we've never seen before. This is an example. They issue these research reports, and their comments and insight into companies is unparalleled. I would just encourage anybody in the audience who's not familiar to take a look. I'm sure we'll be spending a little more time. We will come back to that in a few minutes with the top performing funds. Here's a snapshot from Cy Lynch's presentation where he talked about getting a leg up or stacking the deck in your favor or whatever. He's just pointing out that the market return forecasts fluctuate. Stock prices fluctuate, therefore forecasts fluctuate. And you can see here's our typical graph showing that there is a range of, I should do it on this side, the red is the return forecast for the stocks in the Value Line Investment Survey, and you can see that it doesn't stay, right around 10%. It fluctuates from mid-single digits up into the 20s. And so I just basically went through and pointed out that you can see some of the numbers there, anywhere from basically 7 to almost 30%. And that is what's shown in the graph. So it's just a reality, and he spent some time talking about that. Here's a longer-term look at that same information that I had almost forgotten about. This goes back to the 1960s, where we had taken a look at the return forecast via Value Line and just pointed out that, yeah, it does fluctuate. And we've talked about a number of those moments on there. Those were not world-ending Armageddons, although they felt like it at the time sometimes. But the return forecasts do fluctuate. All right. During the celebration for the presentations, we actually celebrated our results from a year ago. During on May 14th, 2020, the panelists selected that group of stocks, and we like it when things turn out this way. You can see Pat Donnelly brought home Stone Co. with a gain, basically tripled over the course of a year. And those numbers are all pretty spectacular from top to bottom. When your worst company returns 22%, I'd say you're doing something right. And so an 87% average return for the panelists versus a market at 55 means that we beat the market by 30% or so. As Kim would say, ka-ching. All right.
Pretty special. It's pretty special.
Yeah, that was fun. It was fun watching that in progress. So here are the stocks that were chosen by the panelists this year. Again, they're just coming out of the starting gate, but this is a collection of stocks. I would argue that many of them are good stocks to study. I own several of these, some of them since this presentation. Do have Gossamer. Kim, I think you're a fan of Palantir, also with real money.
I do own it, I will admit. And I do own Ardelyx, I will admit.
Okay, so you own both of the companies you presented. I can't even say that. But I did take a position in Emergent Biosolutions here recently. We'll talk a little bit more about that. And I've owned Google for quite some time, but Vertex is one that we have owned in the past, and I just started another position. Vertex paid for the furniture in our low level of our house a little over a decade ago.
Mark, didn't you say that Vertex has a drug that's coming up soon to see if it's going to be approved?
Well, to be honest, I want to go back and listen to his exact comments because it's probably something to follow up on.
I can specifically, my ears perked up on, there is a drug for sickle cell anemia, which is supposed to be possibly approved by the FDA in June.
Okay.
I need to figure out what's the date.
Yeah, and of course, Ardelyx has been kind of a community favorite for a non-core / speculative stock for the last couple of years. It's a roundtable holding, and they had a tiny setback with the FDA recently, and just had to do some refiling. So some of the FDA activity was delayed, and I believe they're looking at FDA announcement sometime in June also. Certainly no later than September, as I recall. You're closer to it than me.
They found out that on April the 29th, and they wanted more studies and information because the mechanism of action of the drug tenopor is so different. And interesting enough, one of the partners of Ardelyx out of Japan, they started 2 or 3 new studies 2 weeks before that April 29th date. So I'm kind of anticipating that 2 or 3 weeks before that July 29th, 3 months later date is when hopefully we'll hear something on that.
Okay. All right, so let's keep rolling along. The scoreboard has been established for this grouping of stocks. It's way too early to make any judgments about any of these, or I will point out that Emergent Biosolutions is not in last place, and I enjoy that. But Matt Spielman kicked the doors open, and he actually was up 50% until Sophie came back a little bit in the last couple of days. But Palantir is up there at the top. Again, it's very early. It's only a few weeks into this, and the purpose of this slide is more to say thank you to the contributors and panelists during that particular conference. All right. So let's go ahead and talk about the stock that I did want to feature in this month's newsletter. It is Regeneron. It has been featured a number of times at the roundtable, and it's been kicked around in our community. There's a lot to like here. Some of the major things that I notice is a nice stabilizing growth rate, a little bit of a bump in sales in 2021. That's because they kind of stumbled into participating in the COVID therapy stuff with that injection that was on your cover slide. So that actually gave them a little bit of probably a non-recurring bump that actually shows up and translates into profitability down there also. So this company is kind of firing on all cylinders. What I find fascinating is they've been stuck in a multi-year trading range, and that spells opportunity from the perspective of a lot of us here. We're talking about a company with double-digit growth rates, very respectable profitability. I mean, look at these trends over the last few years for net margin. So we're looking at a double-digit return, good quality, in the buy zone, really, really outstanding projected return on enterprise value. Just a whole lot to like here. Maybe wait for a pullback, but as for me, I will probably be accumulating this so long as that flat spot continues. Flat spots over an extended period for long-term investors can be a gift. One of the things I also wanted to point out to everybody was that if you go to YouTube and just search on Manifest Investing Roundtable and then stick in the ticker in the name of any stock, you actually are very quickly shown where you can actually go back and listen to the coverage. In one case from 2 months ago, when it was renominated by both Cy Lynch and Ken Cavola back in this time frame, and then back a couple years ago when I presented it at the National Convention for NEIC Better Investing, and the audience liked it too. So it's been working out pretty well. You can see from the annualized returns and the relative returns, and we are 7 for 7. I'm knocking on wood. But that is a way to find back old presentations. If you go back to that May 2019 presentation, there's the cover slide, one of Kim's all-time favorites, with her long rolling hair.
Yeah, and I've never had long rolling hair.
Well, you have now. You have.
Yeah, really.
So obviously that was back during the final episodes of Game of Thrones to give you a date stamp, but some people have said the Knights have rarely looked better. here was the presentation made back in that time frame. Again, similar situation. It has continued. The flat spot has continued for a couple of years. So again, that's an accumulation opportunity from the perspective of many of us. Here's some of the slides that I used back then, and what I find fascinating about going back as I review a company like this is it's always great to go back and say, what did they say they were going to do, and what have they done? Companies that do what they say they're going to do, unless they've got a good reason for doing something else, can be quite appealing to investors. So, I mean, their big drug is this Eylea for acute macular degeneration, and it provides a real nice cash flow stream, very steady. They have significant competition from a couple of major players, but that's been true all this time. They are losing some patent protection, but they're basically finding a way to get through. We also covered this slide. Again, as I said during the presentation, you can actually listen to the company talk about a slide like this for a couple of hours. But what it comes down to is these guys are doing some really neat stuff in dermatology, asthma, some crossover medications, some work with cancer and Dupixent, and the carcinoma stuff that you see down there on the lower left. But the bottom line read out of this is this has persisted and continued, and the pipeline is generating results. And as Hugh McManus pointed out during a recent roundtable, these guys are really developing effective solutions in a number of key areas with health and restoring health for citizens of this planet. So it's an interesting story. It's an interesting story. Another fun fact for you, it was the 500th selection made by the roundtable. It happened to be made by the audience during that April 2019 session. So the audience actually made the 500th stock selection in the roundtable tracking portfolio. And I do like to point out that that's actually almost a majority. Doesn't happen very often to me, Kim, so I have to bask in those moments when I get the opportunity.
And you should. And we should.
All right, so here's a quick summary of the company as we see it today. The stock price is around 500. Again, this is very much a preferred procedure. This is a stock selection guide as you're looking at it with, again, a $9 billion company growing at 11% with 40% net margins, and a PE that probably is a little bit, I'm not going to say pessimistic, but conservative at 15. Could probably afford to be a couple notches higher than that. Even with a conservative PE estimate, you're looking at a double-digit return. Again, the average stock right now is 5 or 6%. So not a bad situation right now for Regeneron. Any comments or questions, Kim?
No, I just am looking at this and thinking I need a pharmaceutical company in my portfolio, and thank you for the idea.
Yeah, I would definitely challenge it with a couple of the others that were brought up, and could lead to some interesting places.
The one I'm looking at right now, which interests me, is Merck, because of the recent spinoff. And the big things that I've noticed with the spinoff is Merck was actually paid by the spinoff, I don't know, like $60 million. And I think a lot of the debt went to the spinoff, which it tells me that probably the parent of Merck would be the better deal. But I still have to do more due diligence.
Yeah, that's one that has come up on a number of screens lately, and I'm pretty sure that Ken Kavula's investment club probably raked that thing over the coals recently. So it'll be interesting to see what Ken comes up with. I think I shared with the audience that Merck, still own it, was one of the first companies I bought back in the early 1990s. Not the first, but one of the first in our Chicago-based investment club. All right. Let's talk a little bit about people who seem to know what they're doing. There's a reason we keep track of this listed as a source of ideas for us. And what you see is the top 20 funds. These are ETFs, the ones without an M are ETFs or closed-end funds, but there are no closed-end funds on here. So if it has an M in front of it, it's a traditional mutual fund, as you see here with, for example, well, this one right here, mutual fund, Fidelity Growth. So that is a mutual fund, and these are ranked for their long-term performance, their performance since the date shown, and here are the annualized returns and the relative return. So again, it's a matter of how well have they done versus the market. In the case of ARC Innovation, even though it's only got 7 years of operation, for those 7 years, it has beaten the market by 18 percentage points, and I think you can see versus all those other numbers, if this persists, that's a pretty special performance. And they are having a rough first half of the year. They are very aggressive, but Kathy Wood is also has a lot of conviction. And in fact, I have recently bought shares of this one just simply because I believe in the very long-term perspective. So treating it as a non-core, but buying it as it's just been beat up so much. So from top to bottom, you can drill into any one of these funds. We'll show you what the guts of ARC Innovation looks like here in a second. But this is where we find a lot of ideas for new companies to study. The ones in red actually have a higher sales load or commission or are closed to new investors. So they just kind of a red flag to remind me, but that doesn't mean they can't be studied as a source of ideas. The one thing that we do like to point out about this list is right here, and some of you are very familiar with this. If you look at the average of the sales growth forecast for the companies held by these funds, it's 15%, which is significantly higher than the average portfolio out there. So again, one of the key success factors is enough growth. That's why you hear Ken and I talking so much about discovering promising, faster growing, smaller companies. So a good source of ideas, and this is covered in this month's newsletter. Here's a look at some of the holdings. And again, you could drill down through these holdings and see if there's anything there that reaches out and grabs you. Like I said, I actually took a position in Skills. Where is it? Is it not even on the list yet here? So no. It's not even in their top 20 or 25 holdings. So I would have had to drill down a little bit deeper. Again, I bought it back at the time frame that she bought it originally. So it's not in the top 80% of holdings yet. But Tesla is their top holding. Teladoc is number 2. Roku, which turned out to be a really good idea. Shopify. I don't know if Spotify is on here, Kim.
Yeah.
Zillow. Here's Planeteer that we had talked about a little bit. This is CRISPR, the genome company. So again, pointing out that this can be in a place where you just kind of click through and follow the ideas. Here's the gambling stock, DraftKings. Here's SE is one of the leading gaming stocks. So from top to bottom, it can be an interesting place. Notice the growth rate of the overall portfolio. And another thing I like to point out, here's the Value Line low total return forecast. You could say the same thing with Morningstar. Morningstar and Value Line, they really struggle with companies like these. Very early stage, very high momentum. They can really struggle, so I almost set that last column aside in most presentations. Moment on Tesla. They keep getting beat up for and criticized for the amount of Tesla that they own. What I find compelling, and it's something we've talked about at bull sessions repeatedly over the course of the last year, is Tesla's not a car company. So when the talking head gets on CNBC and talks about comparing Tesla to Ford, that's just not a very good idea. It would be more meaningful and more appropriate if the talking head were comparing Tesla to Google, because that's how different the situation is with some of the other stuff that Tesla is involved with. So yeah, they're into cars, they're into autonomous vehicles, they're into batteries. Yeah, that's all true, but they're also into mass transit, drilling holes from Las Vegas to Los Angeles, and putting people on Mars. I don't think Ford's doing any of those things. Okay. Any other comments or questions on this, Kim?
Nope, nothing at all. It makes me want to go out and do some
Do
more
some study?
research.
I did take a position. I talked about it during the recent presentations in Exact Sciences after driving by their building. And we're not supposed to invest in companies with fancy buildings, but these guys are doing a lot of neat research in healthcare detection and monitoring and working with the Mayo Clinic. And I have a niece that works there, so I had to buy a few shares so that I could tell her she works for me now.
The question is, does she agree with that?
She actually welcomed it and asked for a raise. So, and I told her I would do all that I could to get her that raise. All right, let's talk about our Sweet 16 screen for June. This one is really kind of cool. I know New York Nick is in the audience. Nick was the one who kind of inspired this. We caused quite a stir with our talk about zoning, and we're going to continue to explore that topic soon, probably featuring some of the stuff that Nick has been sending me. But Nick basically asked the question, what's in the buy slice? I mean, we all know that it's a little more difficult to find stocks in the buy zone. There's a few more stocks in the sell zone than we have seen historically. That's just a sign of an overheated market. But the buy zone is pretty lean. So we took the question to the next level and basically said, well, let's talk about companies that are in the buy zone that are actually triple play candidates also, and that basically have the highest upside downside ratio. We're going to be talking more about that in future bull sessions and some other sessions, but again, a very high upside downside ratio like you see here just simply means that the company's trading near its 52-week low. And there's some pretty good studies there. I did feature strategic education during a recent webcast, and some of those other companies have emerged, including Emergent Biosolutions, during presentations. There's Kim's Merck that she was talking about. A lot of people scratching their head over Merck's appearance here. And International Money Express is one that we absolutely have to take a closer look at, Kim.
Okay. I haven't heard about that one. You'll have to tell me.
I don't know what we'll find, but these are screening results. They're just a starting point, and we'll see where that goes. But there's a list of 15 or 16 companies that could be decent studies right now. There's a handful of those that are actually on the best small company list for this year, so we already have our eye on them. Ollie's was selected by Pat Donnelly during the Successful Investing Conference. There's a couple other ones on there that were subject of conversations during the conference. Car Gurus is kind of interesting if you're a car guy. All right, so that's the other thing, and I am confident that we're going to put the triple play as a screening option, probably with RSI in the stock search at Manifest Investing relatively soon. So stay tuned. Obviously, I'll let you know about it when it's out there, because it's going to be fun to be able to take your screening results and check a box, say, is it also a triple play?
That'd be great, Mark. I'll look forward to that.
I know that you're a fan, Kim, so that's something that we will be doing. All right, in the newsletter for June, we continue our coverage of Tin Cup. Tin Cup has had a heck of a good year. Again, for those of you that are not familiar with it, we launched this portfolio back in my days with Better Investing, actually. And it was inspired to be taken public by Dan Hess of North Carolina. And basically what it amounts to is buying better companies at better prices. Truly deploying our philosophy, and it attempts to demonstrate putting the maximum allowable amount in 401ks in stocks. You know, going back to the mid-1990s, it was hard to find a plan provider who would actually allow you to do that. But a lot has changed since then, and there are more stock-enabled capabilities in retirement plans than there used to be. But this was a simulation just saying, well, what if we were able to do that? And it's been quite a run. We recently topped 4 million, actually ducked down below it at the end of last month, and we are back above 4 million. And it's kind of fun to watch this thing. The performance of the fund since inception now, the internal rate of return is now up to 16%, which is kind of amazing. Every single decision is detailed in the monthly newsletters going back and on the Manifest Investing Forum. This is the current, as of the end of May, portfolio for Tin Cup. It's sorted from top to bottom by return forecast. Again, we shop at the top and we drop at the bottom. So the companies down here are the ones more likely to end up on the hot seat and be considered for sale. At this time, though, Tin Cup is in the sweet spot when it comes to the return, excellent quality, and the growth rate's pretty good too. So the portfolio is just fine. In general, it doesn't need any extra help. So here's a look at the worksheet. We refer to this as our sandbox. And the company that actually does show up on the hot seat for this month was Charles Schwab. We've talked about it for a couple of months. There's a number of schools of thought out there on Charles Schwab. It did represent 7% of the portfolio, so it's a significant piece. It's had a dramatic run up, nearly tripling in price over the last several months. That has driven the return forecast down. There are a couple schools of thought out there. The analyst consensus seems to see a fairly mundane expectation for the combination of Charles Schwab with Ameritrade. There are others who believe in the synergies and cost savings that see a pretty powerful future ahead for the company. Quite a banking behemoth comes out of that situation. I'm kind of on the side of the consensus that the stock price has been driven up, and the combination will be hard pressed to deliver on some of that kind of stuff. So we actually took a look at taking Schwab out of the portfolio and replacing it with a couple other things. Here's a look at Schwab showing you that here's that step change in book value with the addition of Ameritrade. And again, I'm not saying it's a bad company or it's a bad thing or any of that. It's a good company. It's a great company. It's just had a really dramatic run up in price. You can see here that it was down in the 20s not that long ago, and now it's in the 70s. That's a really dramatic run up. And as Kim said, there's no law forbidding us from taking a profit and returning if it ever made sense to do so. But that's the situation at Charles Schwab. On this particular worksheet, we took a look in the left column at the company as if it were a traditional industrial company. So this is sales, and this is net margin. On the right-hand column here, this is book value here, the 2390, and this is return on equity for 11. You basically end up in the same place, similar earnings forecasts, similar other stuff, but again, a return forecast approaching zero, no matter how you measure it, and we're going to give it a timeout. So what we did is we accumulated a few more shares of A2 milk up at the top. I'm being stubborn on that one. It was a relatively small position. It's still relatively small, even after tossing a few more dollars at it. Gentex actually came up at the top of a number of external screens looking for a company outside of the Tin Cup portfolio. So we went ahead and accumulated a few more percentage points of Gentex also. And then the company that showed up that was fairly interesting on external screens ended up being Addus Home Care. And they seem to be doing a pretty good job managing a very challenging turf. Could be a slightly controversial selection, but we did put 3% of our total assets into Addus. And I thought I had a closer look at Addus, but you can actually find that on the Manifest Investing Forum if you want to take a quick look at the snapshot, and I can actually dive out and do that. But that is the company that we added to the portfolio. Any comments or questions at this point, Kim?
No, looking at this, the quality is what everyone needs to recognize, because if we do end up with a recession, we want to have great quality stocks in our portfolio, because those are the ones that are always going to bounce back faster.
Yep.
And those financials, you've got healthcare, which always does well. And I look on here and quickly I see Bristol Myers, ABBV, Gentex, Jazz Pharmaceuticals. So looking for quality, that's why I think these healthcare companies are coming up. And that's something that we all should be aware to check our portfolios and where is the overall market, what's happening out there. But you always want to have quality. More than anything, you got to have quality.
Yeah, and in fact, Cy Lynch would say not just quality, but if you really believe that we're about to head into some economic turbulence or disruption, that, you know, perhaps elevating the financial strength is a good idea too. So pursuing fewer investments like this one, if you really think that the market's going to be challenging going forward. But again, I would point the audience to, we're talking about a very small portion of this portfolio. Okay. Well, let's go ahead and wrap up with just a quick reminder that if you do go to the YouTube channel, search on Manifest Investing, you find a bunch of archived presentations, including all of our bull sessions and roundtables. And now this session will be there also, but the 15 entries that you see on your screen are those successful investing conferences. And you can go back and check into any one of those. I'm going to go back and see if I can find what Hugh said about Vertex, as Kim was talking about a few minutes ago. But again, all of the bull sessions and roundtables are there. We would greatly appreciate if you would hit the subscribe button while there. What that will do for you is notify you anytime that content is added to that YouTube page. But longer term, it's got some interesting ramifications for us going forward and what we might be able to do reaching more investors. So just something to keep in mind. So with that, here's your reminder of the future events coming up. Again, the next one coming up is Tuesday afternoon. For those of you that have day jobs, we do archive all of these and put them on that YouTube page so you can go back and listen to them. The notes are always in the Manifest Investing Forum, so you can go back and check it. But you're invited to join us at Tuesday at 2 Eastern Time. We kick around a number of things, and I'm not sure where we'll go this week, but probably looking at some of those actionable ideas that we've been pondering here over the last hour or so. The next roundtable is a few weeks out. The June roundtable is Tuesday, June 29th. I said Tuesday this time, Kim.
I noticed. Very good. I noticed.
Giving myself a gold star for that. And if you like this program, just in terms of giving you a quick look at what's in this edition, that front section was a little bit lengthy because we talked about the Successful Investing Conference. But every month I would welcome the opportunity, if you guys find it helpful, to dig into some of the individual features in greater detail. So you let me know when it comes to that.
Mark, we do have a couple questions. Someone is asking, how do we get this letter that's available that you talked about, the newsletter of expected returns?
Okay, let me go ahead and jump out of here. I'm just going to go to the Manifest Investing website. Okay, the actual newsletter itself is on the home page. So here are the 4 sections that are there. I will be adding the cover story there later today, and then you will be able to actually have access to the PDF. It'll be right here, and I'll post actually the link to the PDF and all that kind of stuff right here in this week also. Here's the sections of the newsletter in this week, so you can actually access it here also. Again, the link to the PDF will also be here.
That's great. And the next question was, did you have any concerns about the class action lawsuits that are filed against Skills?
I don't have any awareness of that. I will say I am universally / globally skeptical about lawsuits. in general. Yeah, I mean, you have to have a pretty nasty situation to have that become material. And I mean, we talked during the investing conference about a couple of companies that have a bunch. Emergent Biosolutions has at least 100 class action suits filed. I think mostly without merit. Merck has dozens on their docket, and with a company like Merck, we call that Tuesday. That's kind of our message. Now, that's not to say that you can't have a legal situation that can hammer and disable and perhaps even destroy a company. But in general, I don't allow the lawsuits to bother me.
Okay. And that you've covered pretty much all the questions. So thanks so much, Mark. I think I've really enjoyed this, and it's sometimes Saturdays really do work better because you start your day off and then you're free.
Yeah, I'm going to go watch a soccer game. Thanks for helping out, Kim. And again, please, everybody, if you have any suggestions or comments, let me know what you think, and we would greatly appreciate that. So with that, I'm going to go ahead and sign off. Everybody have a great weekend out there, and look forward to seeing you soon.
Take care, everyone. Have a good weekend.